You all who took the time this afternoon to join us. We're going to look to accomplish a couple things this afternoon. One, it's going to be a refresher for current clients on our portfolio management process, and hopefully for some guests, new guests, an educational exercise on portfolio management in general. And then secondly, we're going to dive into 2020 and what to this point we have done in response to the COVID pandemic and what we continue to look to do in terms of portfolios. So let's get started. So again, we're going to overview portfolio management in terms of the main goals. We're going to look at likely future stock and bond returns, why we think alternatives are important, alternatives that we think you should avoid, and alternatives that we utilize. And then we'll end with specific COVID-19 market update and the research we're doing involving COVID-19. And then I'll also mention, if anybody has any questions, there should be a chat bar available. You can enter your questions through that chat. They will not be visible to anybody else but us. And then at the end of the presentation, we will answer any questions that were entered during the presentation. So we'll begin. So main goals of portfolio management. So the first is reduction and control of risk. And really we look at risk in four main pieces. You have the stock market economic risk, which we just went through and are still going through in terms of economic downturn, stock market volatility, reduction in earnings. And we've obviously seen that with the 35% drawdown on that side. And on the flip side of that, you have interest rate risk, and that is having to do with bonds. If you hold bonds that mature in 10, 20, 30 years, you are making a bet essentially that interest rates will not go up, because if interest rates go up, bonds go down, and that's interest rate risk. Inflation risk, of course, is, if you just hold your money in cash, earning 0 or next to 0, and then through time, inflation runs at 2, 3%, 1%, you are losing actual purchasing power. That's inflation risk. And if taxes are involved as well. So if you take all these four risks, inflation, interest rate, stock market, volatility, economic risk, and tax risk or tax minimization, in the middle there, you want all those things looked at and mitigated in terms of your desired portfolio. Second, generation of income. So this is important for a lot of clients to, regardless of the value of the portfolio going up or down, being able to derive income from the portfolio in the form of dividends or interest. And these are some larger components of that. So higher risk bonds or high yield bonds, emerging market bonds, these do have higher yields, but along with that, you have higher credit risk. They tend to be more volatile, and they're usually correlated to stocks. So if you're buying a bond in the hope that it moves the opposite direction of stocks or give you diversification against stocks, high yield bonds are not really going to do it. And we've certainly seen that this year. However, from time to time, they do present value, and currently might be one of those times. So currently from high yield bonds, US high yield bonds or junk bonds, you get somewhere between 5 and 7%. Dividend paying stocks. So these are classic where you get income from the stocks and you get income growth over time, hopefully, as earnings grow with the companies. And here you could buy individual stocks, dividend funds, utility companies. And these are obviously stocks, so they'll be volatile at times. They're obviously economically sensitive, but they do have that benefit of income and income growth. And as we speak now, it really runs the gambit, but you could get stocks paying 1.5% to, in general, 5.5%, and a couple out there even, you can get more than that. High quality taxable bonds. So these are true bonds in the sense they do offer good diversification benefits, which is important. These are the types of bonds that held up very well this year so far. So treasuries, if you bought a mid to long-term treasury, you could be up 10, 15% on that during a recession, and that's really why you hold these. The downside of these, especially now, is the yield you get on them. So currently on a 10-year treasury, you only get 0.65% per year for the next 10 years. So they do provide diversification benefits, but the yield or the return you're going to get is very low. Investment grade, we do see some opportunity there. There you still, for the most part, get that diversification, but you maybe could get 3 to 3.5% yield on top. Other areas for income, real estate. So lots of ways you can invest in real estate, mortgages, private real estate, which we've been a proponent of over the last couple of years, real estate funds, publicly traded real estate, which is called REITs. And here, usually you have higher yields than most stocks and high quality bonds. These can be sensitive, especially public real estate, sensitive to interest rates and the stock market, because these are related to the economy, of course. But they could also provide income growth, much like a stock. And currently, as we speak, in general, real estate, you get 3 to 5% yield off those. Alternatives, which we'll get to in a minute, they could really, we utilize these a lot, not just for income, but for correlation. These could be private equity, private credit, infrastructure, private lending, insurance securities, farmland, and more. Here, you usually do get higher yields. You usually no or little relationship with stocks, bonds, or the economy, and that's why we do like them. And 2 to 6% plus, depending on the investment. And then lastly, tax-free bonds or municipal bonds. And these are useful for clients in high tax brackets where you get 1.5 to 3.5% tax-free. But if you are in a high tax bracket, that could be much more. So depending on the risk level, the type of client, your time horizon, you could use any of these types of securities to generate income. Now we'll look at minimization of tax as a goal of portfolio management. So here we look at tax loss harvesting. Here we have on the left an example of a portfolio where we did no tax loss harvesting. So we have a long-term gain of 10,000, and in the portfolio haven't been harvested, but there's a loss of 7,000. If we did nothing to that portfolio, you would have that $10,000 gain, and at a 15% capital gains rate, you would owe $1,500 in tax. On the right, what we do through November and December, usually each year and throughout the year, if we have that same realized gain of $10,000, but we see an investment in the account that has a loss sitting there of $7,000, what we'll do, proactively sell that loss or harvest that loss of 7,000, immediately replace it with something. It can't be identical, but it can be very similar, and there's a lot of ETFs that we use interchangeably. So your investment stance has not changed, but we're left with, instead of a 10,000 realized capital gain, we're down to a $3,000 realized taxable gain. And in that case, at that same 15% rate, we have $450 in tax instead of the $1,500. And that has a tax deferral savings of a little over $1,000. So we look to do that, and 9 times out of 10, there is opportunity to do this on a year-by-year basis, and that could just basically keep deferring tax that you have to pay out of pocket through time. So next, another strategy for a minimization of tax. If we have a client with 2 types of accounts, or 3 types of accounts. So they'll have maybe IRAs, Roth IRAs, taxable accounts. What we'll look to do is still look at the portfolio overall as one. So we'll still look at, all the different asset classes, the risk level. But what we'll do is we'll overweight or stuff tax inefficient assets. So that's real estate, treasuries, high yield bonds, insurance securities, which we'll get into a little bit, into the IRAs or the Roth IRAs. And we do that because high yield is an example where it has 5 to 7% in interest it pays out. And that interest would be taxed at ordinary higher rates if held in a taxable account. So if we could get that into Roth or IRAs, we either eliminated that inefficient tax or deferred it. In taxable accounts, we'll put equities, all types of equities, commodities, tax-free bonds, of course, and if there's any cash. And this asset location is what we call this. This, again, is another way either to keep deferring tax on inefficient assets or eliminate it in the case of Roth IRAs. And then another strategy we utilize is, of course, municipal bonds. And this is an example where if somebody's looking at, or investors looking at a couple different bonds that on the surface seem identical. So we're looking here on the left and the right of let's start on the left with a taxable bond. So this is a normal taxable bond, maybe it's a corporate bond, has a rating of AA, 20-year bond with a 4% coupon. So you would say, okay, 4%, pretty good, but the investor's in a 30% tax bracket. That would bring the actual after-tax net return to the investor down to 2.8. On the right is a municipal bond or a tax-free bond. And even though the coupon is less, so the coupon's 3.5 versus the 4. So on the surface, it looks less, but since there's no tax due, you can bring it down to 3.5, the after-tax net return, because there is no tax paid. And even though the coupon's higher on the left bond, your after-tax net return is indeed higher with the municipal bond. So that's a calculation we do for all clients. And it really has to do with their marginal tax rate and what bonds are available out there. And then it's not, before I get to the next slide, it's not on here, but another tax minimization strategy we utilize, which is more complicated, is Roth conversions. And that has to do with converting money that's in traditional IRAs, possibly into Roth IRAs. You do pay tax on that conversion, but there can be special opportunity to do so if you happen to be in a low income year and therefore a low tax year. And this year might be one of them, actually, with the elimination of the RMD requirement for this year. So that's something you might want to talk to your Traphagen advisor about. This looks at trying to balance the search for yield. A lot of clients and a lot of investors are really looking for yield, but that's a balance really with total return. So on the left, on portfolio number 1, you have on the surface, maybe looking like a superior type portfolio. So this would be where somebody looks at this cash yield at 4%. It's great. It's a high cash yield, just dividends and interest. But maybe this is more bond heavy, lower growth, more value oriented. So the average growth on top of that income is only 0.5. So that would get you a total return of 4.5%. And let's say this investor has a withdrawal rate of 5% per year. That on average is going to get you a negative pull from the portfolio, which of course, if we can avoid it, we don't want. Now you go to the right on portfolio 2. Again, on the surface, it looks like a pretty low cash yield, so only 2% versus the 4. But maybe this portfolio has more growth stocks in it, less bonds, maybe more technology stocks that are higher growth, but spit out less dividends. Here, have the 2% cash yield, but instead of the 0.5 average growth, maybe we could get that to 3.5, resulting in a 5.5% average total return. And the same withdrawal rate, 5%, and that would be a net add to the portfolio. So really that total return component is what we look for. Yield is a piece of it, but it's really the yield plus the growth in conjunction with the risk. That's the most important. And then liquidity, it's not so much a goal as it is a requirement or something to keep in mind. So, and this again, really depends client by client, but liquidity is basically the time it takes to convert an investment easily and at a good price to cash. So you could use it for spending or whatever else. So this is the pyramid of liquidity, where at the bottom is cash. And of course, that's basically the definition of liquidity. So if there's cash in an account, you could use it essentially immediately for anything. Stocks or ETFs, those, maybe 2 days. So there's a 2-day settlement if we have to sell an ETF or a stock. You get the price, you get it sold immediately. But before you can take the cash out of the account, it takes 2 days to settle, but still quite liquid. Traditional mutual funds and bonds, still liquid. These 3 bottom rungs on the pyramid are all considered liquid. But, if you have an individual bond in your portfolio, it could take upwards of 3-4 days, maybe even a week or 2, if it hardly trades at all, to get a good price on a bond. So still somewhat liquid, but you might have to wait a little longer. And traditional mutual funds, you can't sell during the day. You have to wait to the next day. So it's a 1-day lag there. But all these 3 bottom rungs are liquid. If you go to the top of the pyramid, the top 2, you get into illiquid securities. So these are securities where you're going to sacrifice the ability to convert to cash for hopefully additional return or risk reduction. So the second rung down is what we call limited liquidity alternatives. And these would be the farmland, private real estate, insurance-linked securities, things like that, where it could be anywhere from a month to maybe upwards of a year, where it would take to sell out in full. And again, you accept that level of illiquidity if you don't need 100% of your portfolio to be liquid at all times. And you're looking, usually you get compensated for that in the form of additional returns or risk mitigation. And at the very, very top would be literal if, you had a private personal business that you own private personal real estate, your home. Obviously, those things can take months, if not years, to sell at a given price. So liquidity is, of course, important. And we make sure that our clients with their cash needs have the right amount of liquidity. And then I did want to go over, and this is really a goal, is minimizing fees. So this is an overview. Investment fees are quite confusing. So this chart tries to simplify it, and there's really four types of fees that advisors charge. The top fee is the advisor management fee, and that is usually a flat fee percentage of assets under management. So if somebody has $1 million, charge 1%, that would be $10,000 per year as a flat fee. And that is the charge to research, make the trades in your portfolio on your behalf, just the overall management fee on the portfolio. Pretty straightforward. That's transparent. It does eliminate conflicts of interest. And that is where the industry is heading, to that flat fee as a percentage of assets. Another one is underlying fund or product fee. So this is wide ranging. It's almost getting down to close to free. And this would be the fee if you bought a fund or an ETF or something like that, what that underlying product costs in terms of a fee. So are you paying the managers to manage a stock mutual fund? Or are you just buying an index ETF, which requires very little research, and you could get those for as low as almost free now, or 0.03% or so. And if you have a very complex type of a investment, then it could go up to 2 to 2.5% or so, private equity, things like that. And to try to find your total fees, you would basically add the top 2 pieces of this together, and that would get you an idea of your total fees spent on investments. Now, commissions, everybody's probably familiar with commissions. However, what's great at this point is commissions have basically been eliminated for the vast majority of brokers out there. So for instance, we broker through Fidelity, and Fidelity has eliminated all commissions on all stocks and ETFs, which is great. So that fee has essentially been eliminated. So that's going back further in time, it got higher and higher. So maybe a couple years ago, it was $5, 5 years ago, maybe 10. And then if you go back into the 70s and 80s, it could be as high as $50 or $100 to make a trade. But fortunately, really at this point, commissions reduced to 0. The bottom one is a fee that you should certainly look to avoid. So if you have an advisor that charges loads on mutual funds, these are becoming less prominent in the industry. There can be conflict of interest here for example, if an advisor has 2 similar US stock funds and one pays him 3% as a commission, the other pays him 1% as a commission, could be a conflict of interest there. So, if you look in your portfolio and you see different classes of mutual funds, maybe C class, B class, with a load, you could ask your advisor if you have any load fees. these can be avoided and almost all the time should be avoided. And that's basically the 4 types of fees involved in investment management. And of course, what we try to do is minimize them. They can be directly controlled fees. So obviously, if something's directly in your control, you want to take advantage of it. And we certainly do. So all our traditional investments, our vast majority is stocks, bonds, public real estate, are ETFs, exchange traded funds, which have very low expense ratio and are tax efficient on top of it. And then where we'll pay somewhat more is the alternative in the private investments, where it's just a more complicated investment. But we do certainly think it's worth paying up for that as we're getting return and risk benefits. So here we're looking ahead. So we're saying, okay, traditional investments, what do they look to return in the future? So if you go to the left side, over the past 30 years, so if you rewound the clock 30 years, you got 6.2% in 10-year treasuries per year. So guaranteed investment, you got 6.2% per year over the past 30 years on a 10-year. S&P 500, 9.7. If you had a 60-40 portfolio, equated to 8.3%. Now, question is, going forward, what does that look like? So over the next 10 years, 10-year treasury now yields about 0.6%. Nobody knows exactly what the S&P 500 or stocks will return in the future. Our best estimate is somewhere around 7%, so we'll use that as an example. So if you kept the same 60-40 portfolio, instead of that 8.3, we're looking maybe at something closer to 5%. And, we want to see if we can do better than that. So our philosophy and what we have done in the past couple of years and continue to do is take a big chunk of, and this is somewhat dependent on the type of portfolio, but take a big chunk of bonds out of the portfolio and replace with alternative or private investments, which in aggregate have roughly the same volatility as bonds, really don't add any more risk in terms of volatility to the portfolio, but in our opinion, increase returns over that 0.6. So let's say on the right side of that portfolio, we keep the same 0.6 return for the treasuries, keep a little bit of high quality bonds still, same 7% return for the stock market, and we think we get a private or alternative average return of somewhere about 5.5%. That gets us to 6%. So if we can, even though 1% or so doesn't seem like a lot, if you compound that over 20, 30, 40 years, it is a huge difference in terms of a successful retirement plan. And that's really why we want to incorporate these alternatives. Why are they important? That's one reason, of course. Cash flows, a lot of them do produce higher cash flows than traditional investments. So oftentimes we can get 3 to 6%. Reduce risk, volatility within the portfolio, very important. So some of these have literally zero to do with the stock, the bond market, the economy overall. Some of them have little or a different relationship with it, but it does certainly reduce risk volatility versus just increasing the amount of stocks. And if we replace bonds with these alternatives, we certainly think we could increase returns because the hurdle's so low on bonds going forward. Now, that being said, all alternatives are not created equal. So these are alternative investments to avoid that we do not like. So hedge funds, everybody's probably familiar with that to some extent. Do not like hedge funds. They really are dependent on the manager. It's almost impossible to predict which manager is going to do well or poorly. In aggregate, the fees are very high, and in aggregate, the performance has been disappointing. And we don't like to rely on a manager for the most part to garner returns. We like to look for just a sustainable, long-term source of income, not a manager having to pick the right stocks or bonds or short the right things. So we don't, as a firm, invest in any hedge funds. Long, short, or market neutral funds, you might have heard of these, might not have. These are essentially managers or funds that try to short some stocks, which means bet against them, bet that they're going down, buy some other stocks, which is betting they go up, making it neutral in terms of the stock market. But performance here has been disappointing as well, and fees are high. So we avoid those. Managed futures are investments that basically look for trend following. So if something like commodities, especially, this has been used in, if something's going up, bet it continues to go up. These have had some success, but again, pretty high fees and fairly disappointing performance over the past 5 to 10 years. Foreign currencies, it's a zero-sum game, really. In the end, you would have to have a manager that somehow has a advantage in terms of trading, day trading foreign currencies, essentially. That we don't think is a winning strategy. Again, fees very high there. And annuities and whole life insurance, probably everybody's aware of these things. Occasionally, annuities do make sense. Maybe you're looking for income if you feel, just for your entire life and you have no beneficiaries, or there's a couple other reasons to have them. But for the most part, annuities and whole life insurance are, again, high feed products and somewhat tax efficient at times. Now, these, on the flip side, are alternatives we do like and we have utilized in portfolios. So again, these are not well known to many people. So if you have any questions on any of these, I'm going to go through this pretty quick. So if you have any questions on these, you could ask either myself or any of your Traphagen advisor. But I'll go down with a little overview of each and recent performance. So on the top left, we have private real estate equity. So Blue Rock Fund. This is a fund that invests in private real estate, mostly in multifamily residential and in distribution warehouse related to e-commerce. So they have a little bit of commercial and a little bit of retail, but their underweight to those two sectors have proven very beneficial this year. So as the public real estate market is down about 20 to 25% as we speak today, this fund is up marginally. So it's up 0.2% for 2020. And obviously that's just a huge spread because of the sectors they were in. And private real estate does tend to be less volatile anyway, just by the nature of it. And last year it performed well, up 7.4%. If you go down, insurance securities, this is less well known to many people, but why we like this is one asset class that really does have zero correlation to the economy, stock market, bond market, interest rates. It is literally, you're basically in the same seat as an insurance company, make money by the premiums coming in and by the insured. And if there's a hurricane or an earthquake that causes insurable damage, that's how you would lose money. The reason we like this a lot, and we've been in this since I think 2013, is the returns on average. If you go back to the early 90s when this asset class was created, mid to upper single digits, pretty close to equity-like returns, and zero correlation to the stock market. So for instance, 2020 is a good example. In mid-March or late March, when the stock market was down 35%, this was up about 1.5% with zero correlation. And the same thing in 08. 2008, obviously another horrible year. Stock market was down almost 40%. These were up that year because there was no hurricanes or earthquake that caused damage. So we really do like this for risk reduction and good long-term returns. Of course, there will be bad years. In 17, 18 were two examples. But then in those, after that happens or after that occurs, premiums tend to increase. And that's where we are now in this industry, where premiums have increased significantly over the past couple of years, which have increased prospective future returns. Below that, we have private infrastructure, and this includes private farmland, timberland, toll roads, airports, seaports, things like that, all in one fund. And if you combined all those essential infrastructure assets, you get a fund that's low volatility. Most of these assets have long-term contracts. Again, very, very low correlated, lowly correlated to the overall stock market. Last year, a good year, up 8.2%. This year, down 4.8%. And that's due to mainly a couple of the airports in the portfolio got marked down. Couple toll roads, I think, got marked down. But overall, still, when the stock market was down 35%, this might have been down about 5 or 6. So still much less volatile than the stock market. And that gives you a nice yield, about 3.5%, 4% regardless. Alternative lending. This is Stone Ridge Fund. And this is basically a way to make loans to small businesses or consumers. And it's very close to being in the credit, like being in the credit card business. So here you're making loans, again, small businesses, consumers. Average gross interest rate here is probably about 14% we're getting on the portfolio. Average credit rating of the borrowers are about 700 or so. So not low quality borrowers. And here, again, very low volatility, no interest rate sensitivity. Last year, up 4.8. This year, down modestly, 2.8%. But again, compared to most other assets, that's quite favorable. And since we've been in this for about 4 years, we've gotten every year between 5 and 5.5%, essentially. If you go to the right side, private real estate credit, that's essentially this has been the best performing asset class in the entire portfolio since we got into it 2.5 years ago. Average just under 10% per year, was showing no correlation to the stock market, bond market, economy to this point. And this is the Mosaic Fund. Again, I preface this is only available to accredited investors with 1 million or more in assets. Extremely pleased, and this is a fund that basically makes loans for construction of real estate or renovation of real estate. Private municipal bonds, this is the Tortoise Fund. And this we're excited about. This is a fund that a manager that works with senior facilities, charter schools across the country, healthcare facilities, and on smaller tax-free deals makes loans. They are collateralized. So if something goes awry with the loan, it's backed by first the cash flow of the entity, and then as a backstop, the actual real estate. And here we're able to get the current tax-free yield on the fund is about 6 to 6.5%. And that, if you're on any types of tax rate, is quite attractive. And then lastly, private equity. Private equity is owning companies, mostly smaller to mid-sized companies. And now we're working with KKR for new funds coming in. And KKR is one of the bigger, most well-known private equity firms out there. And here we have a fund of many different private equity funds, mostly KKR, some outside of KKR. And just with private equity, tend to be a little bit cheaper in terms of valuation versus the public markets usually. And there's more leverage you could pull to generate returns. So we do like that, and it has been less volatile than the public markets. So this entire suite of private alternative investments has been some of these are replacements to bonds, and then some of them are return enhancement. The private equity, private real estate credit tends to be more of a return enhancement vehicle, and then the rest tend to be more bond replacements. Now, at the end of the presentation, we'll spend about 10 minutes looking at COVID-19 specifically and what we've done in terms of the pandemic. So this is a chart of the last 5 years, going back to May 2015 to current, of the ACWI. And for those of you who don't know, that stands for All Country World Index. And that's our main benchmark. It's 100% stocks. And it's roughly made up of global stock markets, roughly 60% US stocks, 30% foreign developed stocks. The remaining would be emerging markets. And that's our main benchmark that we use for our portfolios. And what you could see here, between 15 and early 2020, the ACWI, or the global stock market, drifted higher and had a good run. But in the course of literally about 3 to 4 weeks, you lost 5 years of total gains when the stock market was at the bottom because of the pandemic. It wasn't historic in terms of the depth of the correction or the crash of about 35%, but it was historic on how quickly we got to that depth. Never in history have we had a 35% or so pullback in that short a period of time. So it was a pretty dramatic, painful, of course, experience. And then after that, you could obviously see the recovery we've had, which has been impressive and surprising, frankly, for a lot of people. And that's on the next slide. It sort of, it zooms in and it looks just into 2020. So this is a chart of, again, the same thing, the ACWI global stock market from January 1st of this year through, maybe this is a week or two old now. And we sort of broke it into 4 phases of the crisis. In January up and through mid-February, people were starting to be aware around the globe of COVID-19, mainly in China, but they were basically not recognizing it as a risk. So they saw it, they saw news articles on it. Maybe they thought it was, contained to China. It's just going to pass by like many other of these do, Zika, something like that. Didn't really pay attention to it at all. Stocks basically went up from January 1st to mid-February, 4 or 5%. Then in mid-February, there was a weekend where the NBA canceled the season and dominoes began to fall, where it became evident that this was going to be a pretty big deal. And that's when investors began to sell stocks and reorganize their portfolios on mostly fundamental reasons. They're saying, okay, if this is really coming, airlines will probably be hit, so we're going to start selling those, maybe the banks, maybe energy with less demand. So we started to see a more volatile, not gradual is not the right word, but not panic yet, but just a systematic selling of risk assets because of investors beginning to realize what's going on. Then what happened in mid-March was panic. So in mid-March, when it really became evident this was going to be something like we've not seen in at least 50 years, not only did you still get the people liquidating because of valuation and because of fundamentals, you also got forced liquidations, or people, they were caught on margin that had to liquidate. They had no choice but to sell at any price. And we also started to see dysfunction, literal dysfunction in every market, stocks, bonds, treasuries. And that's where you got the swings, on a day-by-day basis of 10, 5, 12%. And it was a crazy time. And that's when the Fed really stepped in and did their thing, along with Congress. So those two actions really of Congress stepping in to pass the small business assistance, the payroll protection, and in addition, the Fed dropping rates to zero, lending money on Main Street, that program is beginning, and actually the Fed's buying a significant amount of bonds, investment grade, some high yield, mortgage-backed, and treasuries. And that really hit in mid-March, and that started to have a positive effect. Stabilized the markets, relieved the panic piece of it, restored that dysfunction in the markets. The markets were started to work correctly. And then what we started to see starting, 25th of March or so, continuing through today, is a gradual increase and in the stock market overall. And it's been impressive. So, we had that initial 35% loss at the bottom. Off that level, we have now gained roughly 30% off the bottom in a matter of 2 months. And this now is a combination of value investors purchasing stocks that got hammered. Some were down 30, 40, 50, 60%. And it's also a lot of other people saying, well, the Feds has a backstop into the market now, so they're sort of protecting us. We have confidence in the markets working, and more people believing that the health, vaccine news is improving. If you look at, we did certainly flatten the curve seemingly as a nation and as a globe, and the worst has passed. And fortunately, that's the phase we're in currently. And, with the last couple minutes here, this is what we've done recently in terms of analysis, where it is not really a stock market, it is a market of stocks. So if you look at, we did an analysis of each sector, each industry here within the stock market and said, okay, over the next 1 to 3 months, how's that look? Over the next 3 to 18 months, how's it look? And then 18 over the longer term, how's that sector industry look? And as you can see here, obviously the red would mean trouble for a while. And then as you go up to the green, really when you talk about groceries, consumer staples, healthcare, pharmaceuticals, most of technology, utilities to some extent, communications, these have not been impacted much, or in some cases actually benefited, so that they're highlighted in green. And you can sort of see our estimates to earnings changes versus last year on the right side. Won't go through all of them, but that's essentially how we're looking at all these industries or sectors. And if you're in the right stocks in the right sectors, you could still do very well in the stock market, even during this type of a pandemic and recession. This is just another chart showing that similar type of thing graphically. So this is just this year. All the lines represent a different sector in the economy. I know it's small, so I'm not going to go through each one, but every single one at the bottom are recession sensitive sectors like energy, financials, materials, industrials, and real estate. And those are still, as of today, down 15 to 35% as a sector. If you go, and that's that red shaded area. If you go the yellow shaded area, that's utilities and consumer staples. These are traditional defensive stocks. So they are down much less. So they're down between 8 and 12%. And then technology, healthcare, which are really the winners here. They're essentially break even. Technology is actually up on the year now, and healthcare is right around break even. So again, if you're in the right sectors, in the right stocks, you can do well. And as a firm, we are overweight and have been healthcare and technology for quite a while. And this I found interesting, where it's not just sectors and industries, it's how healthy a company is. So this is really put into the forefront how healthy a company is in terms of debt and cash flow. So this is a graph showing if a company is very healthy and has AAA rated bonds, which there's not many of those, but there's a couple, those are actually up on the year, maybe 8-9%. And that's what that AAA, that line there just under the 110 indicates. And in that entire green area is investment grade rated companies from A to AAA. And these stocks have performed fairly well. If you're borderline junk investment grade, which is BBB rated, you're maybe down 30% on average. And junk rated, if you have high debt levels, these would be cruise ship companies, maybe airlines, some financials, things like that, you're down significantly more. So it's been a story of industries, sectors, and health of the company. And then just as a little aside, it's, sometimes something happens in the world and you get something that took a decade prior happens in a matter of weeks because of one event. And here is a good example of that. And we're looking at ways to take advantage of this currently. And we already did to some extent. So this is US e-commerce penetration as of total percent of sales. So for every $100 in sales, what percent is derived from e-commerce or online? So in 2009, only 5.6% of retail sales were online or e-commerce related. And it took a full decade to get up to 16%, full 10 years for a 10% increase. In a matter of 8 weeks in this year, that went from 16 to 27, an 11% increase. So it took 1 decade, happened basically, same thing happened in terms of increase in 8 weeks. And that will have tremendous impact on many companies. And we're looking to take advantage of that move, among other ones like this in the portfolios. And lastly, last slide, this is basically showing the trades that we have made already in the portfolios using all that research just went over in terms of COVID-19. All these trades were executed between early mid-March and early April. And just gives you some example of, if you do the research, you look at the sectors, you look at the valuation levels in a panic situation. Obviously, this is a horrible situation. All recessions usually are, but that is when there's opportunity. So these are the trades we made, the tactical trades we made, purchases in that time period. It goes from large cap tech, high yield debt, public real estate, utility companies, natural gas, oil pipelines, high yield municipals, and we're up anywhere from 5 to 25% on that. And that is the last slide, only 2 minutes over, so that's not too bad. And then we'll see if we'll go through the chat and see if there's any questions.
Thank you all, and we will take about 3 questions at this current realm. We have 1 for fixed income, 1 on stocks, and 1 on alternatives. So we'll go with the fixed income one first. And that question being, given New Jersey's low interest rates and really inability to collect taxes, do you find any issue with the pricing of municipal bonds or the prospect of buying new munis in the state of New Jersey in particular?
So good question. Municipal bonds have, of the high, quote unquote, high quality bonds, which include treasuries, TIPS, investment grade corporate bonds, and municipal bonds. Municipal bonds to this point have performed the worst. So municipal bonds to date are roughly break even for the highest quality, and some lower quality could be down as much as 8 to 10%. So there is some concern there, especially with state tax receipts way down because of COVID-19. And if you're asking specifically about New Jersey was in a somewhat of a tougher situation to begin with. This is certainly something on top of it. However, I would say that chances are pretty high that there will be some sort of Fed relief, I would think. And not just for New Jersey, but and there's some been already, and I think more would probably be coming down the pike, over the next 3-6 months. I don't know exactly how long, but the ramifications of no federal help to many, many states, not just New Jersey, would be pretty dire. So we would expect the Fed to come in and support states for the COVID-19 expenses and lack of tax receipts that they're incurring. That being said, though, what we are looking at is a switch or a trend away from higher yielding, lower grade municipal bonds into higher grade, and that's both New Jersey and nationwide.
Okay, thank you, Eric. Let's move to the stocks section of the question. Given the possible delisting of Chinese stocks, do you think this is going to have a negative or adverse effect on the U.S. stock market as a whole?
So another good question, and something that just came up over the past couple of days. I don't think that will have a large impact on the overall U.S. stock market. Now, obviously, it can have an immense impact on emerging market stocks and, of course, the Chinese stocks that are listed on American exchange. And there's some well-known stocks that are listed: Alibaba, Baidu. There's a couple other, significant Chinese stocks on the U.S. stock market. But overall, no, I don't think it will have much effect on the overall U.S. stock market. However, in terms of overall emerging markets, especially Chinese indexes and those stocks possibly that I just mentioned, it could have a large impact. And some of our clients do hold Alibaba, so we're looking at that now and doing research on that now because we do like the company. We think it's in a great position to continue to grow. However, we have to weigh that against, a legislation that might come down in a year or two on the potential delisting.
Thank you again. Regarding alternatives, in specific regard to alternative lending, do you find any issues with the current unemployment level where it stands now? And if there is a prolonged unemployment, would you have any concerns with that type of investment? Alternative lending.
So on alternative lending, unemployment is certainly tied to it. So, if we have 15 to 20% unemployment rates for a prolonged period of time, obviously that'll hurt many things. And alternative lending could be one of those things that it hurts. Now, what happened to this point to somewhat counterbalance that has been what the government has passed. So in many instances, the very people that utilize these loans significantly on the consumer side, they are eligible for unemployment and that extra bump in unemployment. So many of them, and that's what we've seen in the past couple of weeks in terms of that fund, it's actually gone up by about 0.5% or so. Because partially that loss of earned income is being offset by regular unemployment plus that additional unemployment on top of it. So it can, if we have a prolonged, very high unemployment with limited further government support, I would agree that that would be certainly a headwind to that. The offsetting pieces on the other side is, of course, I just mentioned the government stimulus, and also the high-tech companies that supply those loans. They have really cutting-edge data in terms of that's constantly being fed to them. in terms of defaults by zip code, by type of borrower, by credit score, by geography, that they can change their lending standards, they can change their thresholds, the interest rates on a dime, and they've already made a lot of those adjustments. So there's counterbalancing pieces to that. That being said, we very well might trim that fund coming up in the next month or so.
And then we'll turn one over to portfolio logistics as well. This one in particular is asking, regarding the equity part of your portfolio, is it predominantly ETFs, is it mutual funds, or individual stocks? And does it depend on the client situation?
It does depend on client situation. And I would say overall, the way I would look at it is on the traditional side of things. So for traditional stock exposure, traditional bond exposure, real estate, commodities, we do utilize mostly ETFs or exchange traded funds. And that's really because they are very, very cheap. There is no cost, there's no commission to buy or sell them. And if they're held in a taxable account, they're very tax efficient. So for, if not all, almost all of the traditional investments, whether it be stocks or bonds, commodities or real estate, is held either with ETFs. And if we have a portfolio of roughly $1 million or more, we do put some individual stocks in there as well. Where we utilize a modified type of a mutual fund or actual limited partnership structure would be on the alternative side. And those are some of the alternatives I spoke about, which were the insurance-linked securities, private equity, private real estate credit, those type of things. There are just no ETFs available for. So we utilize either mutual funds or LP structure, limited partnerships.
All right. Thank you for everyone for your participation. I hope you found today's presentation informative and beneficial. If you wish to discuss the webcast in more detail, feel free to reach out to any of your Traphagen advisors. And if you don't have a Traphagen advisor, feel free to reach out to the front office and they'll direct you to the necessary party. We will be posting this webcast on our YouTube page in the coming days, so feel free to look at that and share with your friends and family. And we really wish you all good health in these uncertain times and hope everybody stays safe and have a wonderful Memorial Day weekend. So thank you everyone for tuning in and see you guys later.